Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. The Commerce Secretary joins us now for more. Mr. Secretary, thank you for making time for us on a busy morning for you and the team. Appreciate it as always. Let's talk about those deadlines, those dates. Baseline tariffs start on April 5th. Higher tariffs start on April 9th. What happens between now and then?
Well, we are talking to all the trade ministers, but nothing really happens between now and then. What CEOs are thinking about is finally, let's think about building in America. You've got almost $5 trillion of commitments coming to America to build their factories. That number's only going to grow as people realize it's time to bring manufacturing home to America, where the greatest economy and the greatest market in the world is. It's time for America to stop taking care of every other economy in the world and building them up. Let's build the American economy up. Let's build American GDP, and you're going to see great growth from America.
Mr. Secretary, as you know, capitals around the world watching this program right now want to understand what they can do between now and then to avoid those tariffs. What do they need to do? Have you communicated any metrics to them whatsoever?
Well, we've been talking to the trade ministers of the major trading partners for more than a month, and we've been talking to them. And so you have to understand, and this is what's difficult for your audience to understand, that tariffs are easy to understand, right? We have a 2.5% tariff on autos, and Europe has a 10% tariff, and other people have a 20% or 15% tariff. And that's sort of easy, so they can all come down. But it's the non-tariff trade barriers that are the difference. Some countries have a VAT, and they take that VAT tax of 20% and they use it to subsidize the production of their domestic industries. That's why we can't sell cars there, because they give a rebate. Either they give it directly. One country told me yesterday that they give it directly to their car manufacturer to make their cars cheaper. That's why they sell successfully and we don't. Others take the money and use it and give cheap energy costs to this production, and that's why the steel industry, why is everybody else so good at steel and we're not? It's because their governments subsidize it. So we really need to change the way trade works around the world. It's tariffs, but don't get confused that these non-tariff trade barriers, they are the monster that needs to be slayed.
You've been consistent about this argument: subsidized production, manipulated currencies, foreign trade barriers, something the president addressed just last night. Can we just sit on the numbers just for a moment? The EU, 20%, 24% on Japan, 34% on China. Just what exactly was the methodology to go through all those different barriers to entry that you want to knock down? How did you come up with these numbers?
Well, the Council of Economic Advisors, the PhD economists of the administration, coupled with USTR, the United States Trade Representative, they publish a book called Trade Barriers, about this thick, right? And they've been analyzing for decades all of these different tools that these other economies use to hurt America. Right? They won't take our corn in India. They won't take our beef almost anywhere. It's unbelievable. They won't take our agricultural products. They just treat us badly because we've allowed them to treat us badly. And when you finally go back at them and say, this has got to end, it's going to be tough for them because they've built their whole social network, their whole economies on basically exploiting America. And Donald Trump has said it's time for America to change that. It's going to be difficult for them to change that, but eventually America is going to be treated fairly, and the production of American factories is going to be incredibly strong growth.
Yeah.
And you're going to see that growth reverberate through GDP. Remember, people forget the D, gross domestic production. If you buy a foreign-made Toyota, that is not domestic production. Making a car in America, that's domestic production.
Mr. Secretary, if we could just sit on the methodology just for a beat longer and address it directly. This is what we understand, what most people understand you did, that essentially you divided the country's trade surplus with the United States by the total exports and then divided the number by 2 and produced this discounted rate. If you're a trade partner right now and you've just watched how America has put together that policy, how are you meant to negotiate with that? What are those countries meant to say? What are they meant to do?
The countries understand that their trade policies were an exploitation of America. Everybody understands. One country actually said to me, I was amazed that we were able to get away with it for this long. I mean, imagine that.
Can you share that country with us? Because they don't say this, they never say this on the record. You've got the potential, the option, the ability right now to share that with us directly.
Of course they're not going to say it on the record.
Who's saying that to you?
No, come on. Oh, stop. I mean, the country, one country told us that they give the subsidy to the car companies. Another country admitted that they give their subsidy to their steel companies. I mean, they're not going to repeat it on here. What's on here is that this is going to change, that it's time for these things to change. And they're going to be more fair, and America is going to do well. And in the middle of that time, all the factories are going to come back to America. You're going to see an enormous number of factories come back to America, or you're going to see incredible change globally. It's going to take time, but the factories are going to be built in America. That's the most important thing. Donald Trump wants to see steel and aluminum made in America so we can defend ourselves. He's going to want to see pharmaceuticals made in America. Who on your audience doesn't want us to make the ingredients for pharmaceuticals? Did anybody ever ask themselves why the ingredients for drugs should be made in China? Why is that? That's not cheap labor. That's high-tech factories in China. Why? Because their government helped create it. They created cheap goods there. They oversupply them. They drive the capitalist American who don't think like this out of business, and then they make it in China. And Donald Trump has said, I've had enough of this.
I think, Mr. Secretary, most people would totally agree with you. They would totally agree with you because China is an adversary. It is not a partner for the United States. Europe would make a very different argument. And Europe might be wondering this morning why they're being thrown into the same bucket as the Chinese. What explanation can you give them?
Europe does not treat our products fairly. They do not treat our companies fairly. They treat themselves incredibly well to the detriment of the United States of America. Right? It is time for them to treat us fairly, and that is the point. It's not free and fair trade. Their tariffs are higher. The non-tariff trade barriers are incredible. Like, I'd ask you, why don't they take our beef? Why don't they take our agricultural products? Why? Because they don't want them, because they want to make the money themselves. Why is it okay for every other country to feel this way, and it's not okay for America? I tell you why. Because we were the world's piggy bank, and Donald Trump has said our $36 trillion deficit, our $1.2 trillion trade deficit, $1.2 trillion. We buy other people's things more than we sell them ours, has got to be rebalanced. It's a national emergency. Let's fix America, and we can.
Mr. Secretary, for you it's beef, for the president I know it's Ford and Berlin's, but there are products that Europe takes, things like LNG, things like Microsoft services. Do you want to see balanced trade product by product?
No. It's not product by product. It's a big macro issue, okay? Fairness comes when one decides that they can stop, they can't get away with it any longer, so let's make a great deal with the United States of America, okay? They've got core issues. They have a VAT tax of 20% or 20, Europe has 21%. I mean, so when our goods are sold there, we pay 21%. They say everybody pays that. And then they use that money to beat us down in other ways. I mean, come on. We need to have fair trade macro, not product by product. But I think that the way Donald Trump looks at it is country by country. And what's going to happen is you're going to see domestic production grow. You're going to see interest rates come down in America. You're going to see growth in America, great jobs in America. Robotics is going to come to America. It's going to replace cheap labor overseas. Robots can make things. And you know what the job is going to be? Mechanics who fix robots. Kind of like a high-end BMW, robots are going to need to be fixed. And those jobs are going to be high-paying jobs, and they're going to be here. We're tired of them being overseas.
For some countries, there's the 10% base, and that's the only levy that they were hit with yesterday. I'm thinking of the United Kingdom. I'm thinking of Australia. But those countries have a trade surplus with the United States. So why put the tariff on?
Well, I think the president understands that all of these countries, even if they have a trade surplus, if you dig into it, like, for instance, the UK, their trade surplus counts that they have this London Metals Exchange, and so gold and silver bullion going in counts. I mean, come on, that doesn't really count. So, and Australia, which is a wonderful partner of ours, they buy a lot of our planes, right? And if you buy our commodity gas, I mean, that's really what you need, not really what we need to sell you. It's not the same. So the president decided, why don't we have a baseline of 10%, okay, to really understand that everybody needs our economy. Our economy is the magnet of the world. Everybody needs our economy. Let's them pay coming in, and let's change that deficit of $1.2 trillion, and let's make America's economy grow, and let's balance that out. Let's fix that first, and then we'll go readdress the rest of the world. But we need to fix our trade deficit. $1.2 trillion. It's unbelievable why we don't have those jobs and the rest of the world does.
Treasury Secretary Scott Bessent told me last night this is a ceiling. Potentially we can see a different floor. Are you prepared to negotiate all of these rates? Is this truly the start of a negotiation?
Well, it's the start of a rebalancing of the way the world works. I agree with the Secretary that our view is that the only way these rates are going up is if countries decide to retaliate. But why would you retaliate against your biggest client? Your biggest client says, I want to reorder things. I mean, the United States of America is the largest client in the world. And yes, of course the countries are going to talk to us, but they talk too casually. They always talk about their tariff rates. I mean, it's like they say, oh, I'm going to cut my tariff rate. You think the reason we don't sell a car is because Europe charges a 10% tariff and we were only charging 2.5%? That was outrageous. But the key is they have all these rules. Like one of my favorites is the Koreans. When we made a deal with them in 2012, we took their cars, right, Kia and Hyundai, and we were going to sell agricultural products to them, right? And when McDonald's went to send in French fries, they wouldn't let them go in because we couldn't prove the origin of the potato. I mean, you don't understand the scale and depth of how they keep our products out. And Donald Trump has said, I've had enough. We are going to be treated better. America is going to be treated better. And that starts today.
Mr. Secretary, why exactly wasn't Russia on that list yesterday?
Because we have sanctions against Russia, North Korea, Belarus, and Cuba. And so we're not supposed to be trading with them.
Thanks for clearing that up. The additional question that other people had too about Mexico and Canada, they were also noticeably absent. Why were they absent?
Well, they are operating under a rule that was set for fentanyl, right? That they needed to close the border and stop fentanyl. And what that rule is that USMCA, right, the major trading is exempt, right? And the other products that they do have a 25% tariff. When that is resolved, so we're not going to double count it. That's just not the way it works. When that's resolved, they will fall into a model like this. But I think USMCA, in the order, USMCA continues to be exempted. So car parts, for instance, don't come with a tariff if they end up being finished in American cars. So if you're building your car in America and you're getting parts from Canada and Mexico, that's fine. The American cars still come with no tariff.
Okay, that's helpful. The additional question we had on just a few numbers, because we're all trying to make sense of this in real time, and you've got the numbers. What's the tariff on China now? The complete tariff, including everything. What is that number now?
Well, there was a 20% tariff because they continue to make the ingredients for fentanyl and send them out, right? And those ingredients have the highest subsidy rate in China, meaning the Chinese government is paying these factories to make these goods, the ingredients for fentanyl, which is killing Americans, right? So Donald Trump put a 20% tariff on that, and now the regular trade deficit number, right, the analysis by the Council of Economic Advisors and the United States Trade Representative, we have a 34% tariff, so it's 54%. But when they stop making the ingredients for fentanyl, and I want to point out, in 2019, President Xi told President Trump that he would put the death penalty on anyone who made fentanyl. And now he's actually subsidizing them. And that's just so wrong that Donald Trump is just, he's not going to stand for it. And he's got to hit them with the only thing he can
Secretary
hit them
Lutnick,
with, which is economic
on China
penalty.
as well. On China as well, what about the 301 tariffs that were put in place under Trump 1.0 and then carried on to the Biden administration? That's about 25%. Are those still in place? Do they get added to this cumulative number?
They do indeed, but those are on specific product segments, and those still are as well. Autos are not.
So we're talking about 79. So we're talking about 79% for some imports cumulative. We're talking about a 79% tariff from China. Is that accurate?
On certain products, that could be true, sure, but they've got to stop.
The UAE.
All they have to have is a phone call. All they have to have is a phone call from President Xi to President Trump saying, I'm going to end fentanyl production that's killing Americans, and it drops 20%. I mean, that's a pretty inexpensive phone call, but you have to make the decision. You're going to stop killing Americans. And so far, they haven't made that decision. Shocking, but they haven't made that decision. And you really got to think about that for a minute. Think about that for a minute. A phone call would save them 20% on all their products, but they'd have to stop making the ingredients of fentanyl, and they refuse. Outrageous.
Has your counterpart reached out to set up that phone call between President Trump and Xi Jinping?
You know, President Trump and President Xi, they have their own way. They're not going to be, when that phone call gets made, I don't think they're asking me to set it up. I think that's above me.
Mr. Secretary, does that tell you something about maybe the leverage you think you have, perhaps you don't have, over the Chinese? The fact that they aren't reaching out, they aren't doing those things, despite the fact you've put tariffs up as much as you have?
Well, we'll see. Remember, these tariffs are just going into place. And, you know, I think they will have that phone call, and they will have lots of conversation together. I think, for me, the greatest thing for me is that Donald Trump is sitting behind the Resolute desk in the Oval Office, and he is the greatest deal maker, and he will decide how he wants to play his hand. But the way he's played his hand now is, he's been talking about this for 35 years. He wants to reorder trade, to have the world stop exploiting us, to bring the factories back, to bring employment back. You know, no one thought about when NAFTA, which he called yesterday the worst trade deal ever, what NAFTA did, it gave Canada and Mexico sort of the economic right to be a state of the United States without paying federal tax and without respecting the Constitution. But you could build in Mexico and drive to Texas, and build in Canada and just drive across the border. It was all fine, and no economically equal to being Alabama and Georgia.
Yeah.
And so what happened is our manufacturing left America and put those Americans out of jobs. And Donald Trump wants to bring back factories, bring back those jobs, and they can come back. $5 trillion worth of commitments to bring back those jobs is pretty unbelievably impressive. And that's what Donald Trump's capable of.
Also impressive is the sell-off this morning. And a big question the market's asking, how much pain you're willing to tolerate. The S&P's down by 3.7%. The dollar's being sold quite aggressively. Against the euro, we're seeing one of the biggest moves we've seen in the last decade. Mr. Secretary, how much pain are you willing to tolerate? How much market pain are you willing to tolerate?
Donald Trump is focused on the economic pain that the United States of America has suffered over decades. Since NAFTA, 90,000 factories, not jobs, factories, 5 million high-paying jobs gone overseas. He's focused on the U.S. worker and the U.S. economy. And what's going to happen is people are going to realize it is the great American economy that is the winner here. And anyone who doubts it, and anybody who shorts Donald Trump, or anybody who doubts the strength and the power of the American economy is making a foolish bet. Sure, importers are going to have a tough time figuring out what to do because they went and found the cheapest production in the world. It's time to bring that production home, to have the smart, amazing people who run American companies figure it out, bring robotics back to America. And I would say that United States domestic growth is going to have the greatest resurgence ever under Donald Trump, and that's what he has set in motion yesterday.
You'll accept it takes time to engineer a supply-side response, though, sir. And in the meantime, you can see bad things happen. Do you accept that?
Well, what I can accept, of course, it takes time to build factories, but companies understand how to do it. They will do it. The United States of America is the greatest economy in the world. People have to do business with it. The rest of the world will bring down their trade barriers, and you'll see a great resurgence in our ability to sell agriculture overseas. You'll see factories being built here, and that factory production will be faster. So sure, there will be a rebalancing of those who make things in cheap labor markets, figuring out how to make them here. But ultimately speaking, and I think in much less time than you think, the world will reorder itself, will figure it out, and the United States growth rate will turbocharge compared to the rest of the world. We've been too close to them because we've been, our presidents have been presidents of the world. And Donald Trump ran on the policy that he was going to be the president of the United States, of the workers of the United States, and he was going to place American workers first. And that's what he did yesterday, and that's what everybody's feeling. Those workers have been disrespected, and now they're going to be respected.
Mr. Secretary, just a final question, if we may. Any calls scheduled for today with the Europeans? Do those negotiations start this morning immediately? Can you give us a sense of things?
Absolutely. Our teams are talking to all the great trading partners today, and we are available for our great trading partners every day. It is time for them to do deep soul searching of how they treat us poorly and how to make it right. It is time for them to do that. That is going to be difficult for them because they've taken advantage of us for so long. They should just be disappointed that the free ride is over. It's time for them to be realistic and to change the way they look at the United States of America. And I think that's going to happen starting today.
I think it's changing in real time, sir, in many ways. Mr. Secretary, appreciate your time. The U.S. Commerce Secretary Howard Lutnick on the trade tariffs announced overnight from the United States of America. Joining us now for the next 30 minutes or so, the perfect guest, Jim Zelter, the president of Apollo Global Management. Jim, it's good to see you. Good morning.
Good morning, as always.
Congratulations on the new title, because I haven't spoken to you for a number of months.
Thank you. It's been a long journey, and I appreciate the note.
Well, let's get straight into it. You've called it macro paralysis. What is it now?
Well, it is. I mean, I sit here this morning, and this really can't be a surprise. The reality of the surprise is a little bit more painful for everybody to digest, but this administration was very clear during the campaign what their objective was. They really wanted to revitalize American industry. They wanted to bring back manufacturing, focus on energy, focus on industrial renaissance, and tariffs, as Amrita said, tariffs, taxes, and deregulation were the three-legged stool, and right now the focus is on tariffs. They have been probably signaling, I know you're having Secretary Lutnick on later on this morning, but they've been signaling this was the dialogue. This is obviously a long negotiation, but again, this was part of the administration's agenda. This is what they wanted to accomplish. They've been very clear in the communication. So the pain of the announcement is being felt this morning in the market. But again, I'm not saying preaching patience and perspective, but certainly this should not be a surprise. And I think now, as we think about the big trends of the last 20, 30 years, the first of which is globalization. Globalization is not going to be like we have seen it in the past. It's a new global world order. How the U.S. manufacturing and financial base fits into that is a TBD, but certainly it's going to be one that plays out over the next several months.
I can't think of many people outside of you and the team more dialed into the C-suite in corporate America. How are they planning for the changes in the global economy that you and the team are anticipating? Are plans going ahead? Are they on hold? Are they totally derailed?
Yeah, listen, I've used the term macro paralysis because I think we came into the year, the busiest folks on Wall Street were supposed to be the M&A bankers and the ECM folks. And that has not taken place. And so the pace of broad activity in the public markets has certainly been muted. And I think this really plays into, and I've been on this show before talking about the role of public markets and the role of private markets, and not just private credit, but overall private markets. And you're going to see this be a turning point where private markets play a larger role for a lot of these corporates that are still, they have long-term plans, whether it's what's going on in technology, energy, mining, a lot of U.S. domestics. Who's going to finance this reshoring that's part of the master plan? So no doubt, I think, in C-suites and in boardrooms, there's vision, there's a desire, but the practical reality is things have come to a stop. And I know you're going to have Torsten on later on today. The soft data, when you see what's going on with consumers, consumer concern, corporate concern, it's really certainly, it's amazing what the president has been able to do in 75 days, what 400 basis points didn't do over 2 or 3 years. As I sat here a couple of years ago, we talked about the tightening of financial conditions. It didn't happen. The U.S. consumer led in a massive rally and a strength in the U.S. economy. In 75 days, talk of today has really slowed down the economy. So the soft data and anecdotes would tell you that we have, the recession went from a 1 in 5 to 1 in 3, that now, depending on who you talk to, it's north of 50%. It's probably 50% going higher, depending on what happens on the 9th.
There's a lot to unpack there. I want to go back to something that you said, that this shouldn't have been a surprise to anyone. And maybe the objective shouldn't have been a surprise, but the execution is raising some questions for people about how it is going to be passed through. Is there anything about what you have seen over the past week that makes you materially change some of your strategy about how you go forward, how you advise the C-suite?
Sure. Well, let's just go through 2 or 3 things about investing today. And a lot depends on the portfolio or the liabilities you manage. If you run a domestic U.S. long-short fund, this is obviously much more fundamental. We're a long-term, long-duration investor with a lot of investment-grade assets. So when you look around the globe right now, is anything cheap? Not really. Our rates probably going to be, notwithstanding the rate move in the last 24 hours, our rates going to be materially higher over the next few years than they have been because of deglobalization, probably. And then you have to weigh the geopolitics. So certainly your risk parameters and how you want to calibrate risk has certainly gone up the last several months. And the idea of the hurdle of an equity return has certainly gone up the last several months. And with base rates high and getting a coupon, it's all about your calibration of risk. So certainly this has taken a situation where, in terms of what you can get in base rates, in terms of bonds, in terms of fixed income, in terms of fixed income replacement, it certainly made the equity risk premium a lot higher. And certainly for us, we are in the private equity business, we are in the equity business, and for for us, as risk premiums have risen, it's a really high hurdle for equity these days.
Which raises a question, especially if Apollo has really seen the debt portion of your business grow and exceed what you see in the equity. Is that only set to expand, especially if rates are going to remain structurally higher in this new regime?
There's a reason why we positioned our business the way we have over the last 5 to 7 years. Not suspecting a day like this would occur, but the reality is around the globe, you have millions and millions of folks that are ill-prepared, unfortunately, for their retirement and their pension. I was in Asia and Australia last week. Even as well as the superannuation funds have done for Australia, they do not really have a system on post-accumulation and post-retirements. And so around the globe, and even in this country, 11,000 people a day are becoming 60 or turning 65. We're ill prepared for the pension system of tomorrow in terms of the needs. And that's why, listen, what's being written recently about private markets, certainly in Larry Fink's letter, it's a tune that we've been talking about the last several years about changing market structure, the role of private markets with retirement systems, financing what this administration is putting forth. We think we're primed to be at position of first in Maine in what's going on right now, but certainly it's a wake-up call for retirees around the globe.
Jim, let's talk about Europe. There's been a major sentiment shift towards the European side of financial markets and a pullback from the United States. For a long time, we talked about so-called US exceptionalism, and one big feature of that, maybe even the secret sauce, I think Jeff Bezos himself said it, is risk-seeking capital, abundant markets, really, really deep markets, tons of liquidity. Is any of that under threat?
Well, I think that what you're seeing is maybe not the U.S. Going down, but also parts of the other globe coming up. I mean, the Draghi letter that was put out last September that everybody had in the file, they've quickly pulled it out the last 3 or 4 weeks because certainly this administration has woken Europe up. And as they wake up, they're saying, how do we create an economic environment where capital can grow, capital be created for growth companies? Think about a securitization market. You've got a 23 trillion economy with a nascent securitization market. And I think this administration has woken up Europe in terms of thinking about how they actually fund, finance, and grow in this industrial renaissance that's going around the globe right now. So it's certainly been a massive wake-up call. And I think, again, you're going to see private market solutions for many of these countries, companies, and industries, not only in the U.S., but in Western Europe, as they rise to the challenge.
One discussion point has been that U.S. exceptionalism is predicated both on the AI trade as well as fiscal stimulus. That's going into reverse a bit, maybe. At the same time that the fiscal expansion is going on in places like Europe, in places like China, how much do you see that continuing in terms of market performance and something that you're willing to follow?
Well, what you're really addressing is mostly on the equity performance and the public equity performance, where public equity dollars go. Certainly there's been a massive amount of global investment in the U.S. equity markets in the S&P, and that's going to be muted as there's a global pullback as investors think about other parts of the globe right now. But the bigger question which you're really getting at is if a recession coming into, if I was here 6 months ago, we would have said a recession in 25, 26 was 1 in 5, and now that's certainly 1 in 2, if not higher, with what's going on over the next several weeks. The other scenario is the stagflation scenario. That went from a 1 in 6, 1 in 7 to probably 1 in 5 right now, 1 in 4, and that's the concern. That's got to be the concern of policymakers in the U.S., but also around the globe.
Just building on that, before it sounded like you didn't think the Fed could cut rates. You said that this is going to be a permanently higher rate environment, and that happens with both the U.S. as well as Europe. Why? You think that they're destined to allow that kind of scenario?
No, but I think they have when you look at the balance of the dual mandate right now, it's just certainly much more challenging. Certainly the White House is going to want to see them cut rates, but and certainly some of the economic data in terms of slower growth would portray that to be the next move. I think the Fed's going to have to practice much more patience in here.
Lisa, this is the #1 question in financial markets right now. Is that Fed put constrained because of higher inflation further down the road?
Right now, the market is betting that no, it is not, because what you are seeing is more than 3 rate cuts, almost 4 rate cuts being priced into the market by year end, with some like Citi saying that they're going to accelerate them, and others like Morgan Stanley taking away their call. Key question at a time we're coming off a real inflationary bump.
Jim, we caught up with the Treasury Secretary yesterday in the immediate aftermath of the announcement from the President, and he was asked by Anne-Marie about the equity market sell-off since February, the highs of the year, and he pointed pointed to the NASDAQ and said it seems like a Mag 7 problem and not a MAGA problem. Now, you can push back against that, pour some cold water over it, but he has kind of got a point. There's something else going on here outside of just trade.
Well, that goes back to my point earlier. Like, you know, when you look around, like, what is an investor right now? Are things cheap? No, they've gone down in price. But don't confuse a price move with something being cheap. And it was a marketplace that the Mag 7 took the market up, and now the Mag 7 has taken the market down. But again, this is a very, very complex economy. And again, this is the big theme that we've been talking about for years. And I know we're talking about financial markets and the equity market, but these public markets only reflect a very, very small portion of the U.S. economy. Yes, these are great growth companies, they're global companies, but so much of the U.S. economy, so much of the European economy is private companies. And how do they navigate this? And that's what gives us a great deal of enthusiasm, because what's going on for investors in private markets, but also for companies needing capital, there's a lot more tools in the toolbox than there was a decade ago.
Can we just finish, though, on data centers, which has been a major theme,
Sure.
not just in public markets?
No doubt.
There have been some warnings about overcapacity in the last few weeks.
Yeah.
How are you and the team navigating that?
We've certainly taken on much more as a debt provider to date. Certainly those who've been around for a few decades, you feel like you're seeing a bit of the conversation about dark fiber from 98 to 99 and 2001, 2002. Build it and they will come. Certainly there are economics that still need to be developed in terms of the economic model of the data center business. A lot of capital has been created up front to purchase the land, secure the power, create the facility. But who is the long-term offtake of that? Who is the long-term capital? And again, this goes back to the conversation I had earlier about the pension deficit issue. There's a tremendous amount of long-term capital that wants to be matched up with that opportunity set. But to date, we've been much more of a debt provider. But I certainly think that questions that were raised last week by Joe Tsai, pretty legitimate questions about the long-term economics and the short-term supply-demand mismatch about how these things come online and what the economics are.
Jim, we could talk to you all morning. I know you've got a job to do, though. We appreciate your time.
Always
for
a
dropping
pleasure.
by.
Thank you,
Jim. Jim Zelter there, the president of Apollo Global Management.
And for that conversation, I'm pleased to be joined by a friend of the show, Terry Haines of Pangaea Policy. Terry, you put out a note last night. You said Liberation Day tariffs now watched for many, quote, path-dependent negotiations. Do you think all of these rates that the president outlined yesterday can come down?
I think a lot of them can, sure. And the one reason I would say that is that Secretary of Commerce Lutnick has been kind of preloading everything over the past days and weeks with a lot of different countries, saying, you know, here's what we'd like on tariffs, here's what we'd like on tariff barriers, you know, here's the realm of things we want to talk about. Those other countries have already been discussing that internally, and they'll have internal politics as well as external politics, things they can do, things they can't.
Commerce Secretary Howard Lutnick has been in touch with his counterparts. A few times he's been on our program even saying he was going to talk to, say, his European counterpart that day when Trump came out with a 200% tariff on wine, champagne, and cheese. Why not then just do the deal? Why have this destructive, what some would call in the market, moment right now to get to that point?
I think the administration wagers that trade negotiations of those kind never end, and they'd get bogged down in not being able to finish them. I think they think that there's more value in kind of a shock and awe approach that brings people to the table and incents them to do things and actually get something done.
April 5th is when the 10% baseline goes into effect, and then April 9th for if you're one of those countries that has a higher level like the European Union at 20%.
Right.
Do you think we get a deal before April 9th?
I doubt that. Some places will probably have that happen, yeah, but I think the big places won't. There's too much complexity internally in a very large country to be able to check off with stakeholders, figure out how you want to change things, go through the legislative or regulatory process. I think that's all very unlikely.
Trump's entire economic agenda is a three-legged stool: deregulation, tariffs, and tax cuts. If one of these stools collapses, the entire agenda might collapse. How quickly do they need to get the tax cuts to make sure they keep this economy afloat?
I have it at 80% by the end of this calendar year because of that's the way the congressional process will work. Third quarter is largely screwed up because of the need to deal with spending bills. But at the same time, can they do it faster? Sure. And that's exactly what Besson told you yesterday, is that...
That's why they're including the debt ceiling into this reconciliation
Well, exactly.
package.
But he's going to now turn, he's told you, he's now going to turn his attention to dealing with the tax cuts. I joked on your radio side this morning that Besson's going to be the Gary Cohn of 2025. And that's largely the way I think markets should look at it. But Lutnick's going to be the guy who deals with the tariff issue.
Okay, but when it comes to those tax cuts and how quickly they need to get it done, we're just talking about an extension of current policy. The sweeteners, no tax on tips, no tax on Social Security, does that actually get done? The Treasury Secretary seems to think so. I'm not so sure when I speak to sources on Congress.
Do I think it gets done? Yeah, I do. Certainly by the end of the year.
The extras?
Yeah, I think so.
You think all of them, this economy, the budget hawks, the deficit hawks, are willing to sign up for that?
They eventually will be, yeah, because one of the many reasons why there's Trump urgency is because Trump understands that his biggest leverage points politically with members, particularly deficit hawks, come up in the midterms.
All right.
And I think that's where you'll see a lot of that.
Terry, thank you so much for your time this morning. Jonathan, of course, Terry Haines of Pangaea Policy, a friend of the show. He thinks it's a shock and awe moment to get negotiators to the table, but doesn't sound like we'll get deals before April 9th.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.